Good afternoon and welcome everyone to the Deane conglomerate webinar supported by our lovely presenters today. The webinar Swimming Against the Tide. I'm Deane. I'm Director and a Registered Liquidator at Deane Insolvency Practitioners, and I have the esteemed privilege of presenters today. And we've got a fantastic lineup of presenters who are going to help everybody through navigating the toughest parts of COVID and the things that we're all facing at the moment. So our fantastic lineup consists of Andrew Knowles and Martin Lakos from Macquarie, Stephen Mitchell, CEO of Oak Capital and Resicom, which are now combined into one business. Speak to Stephen later if you want to understand about all the things that are happening there. Olga Koski, Director of Texas Shore, Luke Egan from Astor Alliance, Arthur Athanasopoulos, and I said it so well earlier too, Arthur, from Cashflow Finance, Tony Eldred Hospitality and the Director of the San Telmo Group, and Nick Giassimo also from Deane. So why is it called Swimming Against the Tide? From our discussions with accountants, advisors, business owners, the common theme felt like they can't really do anything, or they're not getting anywhere with some of the options that were available to them, and it felt like that they were swimming against the tide. In other words, expending energy and not getting anywhere. And what's harder than swimming against the tide is doing it in the dark. So you can't see the rocks, you can't see the reef, and if you stop swimming, you can't even see how far you've now drifted out to sea. So this webinar is designed to basically be a lighthouse, removing the dark, providing the options for all the advisors and the clients to navigate through the rough seas, or in the most serious of cases, provide the life raft, keep you off the rocks. Businesses at the moment are heavily reliant on the flotation devices provided by the federal and state governments, by the way of JobKeeper, ATO deferrals, grants moratorium, insolvent trading, all that sort of stuff. But if anyone's read the bold disclaimers that go with those floaties, it always says they're not to be used as a life-saving device. And this is how we should be viewing these initiatives. Already a lot of them are being wound back. It won't be around for forever. ATO is going to start recommencing recovery action. They're going to want some money in. And businesses are going to start to trade again in some capacity. So how do we navigate that, survive, and then thrive? So the presenters today, they're going to be part of your own lighthouse, and whatever that looks like for your business or for your clients' businesses or whatever that might be. We're going to hear what we can expect in the market going forward, what it currently looks like. We've just had a budget. What the access to capital is going to be like, the different forms of capital that can be accessed. The two of the major sectors are being absolutely slammed at the moment, both hospitality and construction. We're going to hear from experts on that. Dealing with the ATO, who are quite often the major creditor in a lot of businesses, and put some pressure on businesses, how to negotiate, get around that. And finally, some options around dealing with the worst case scenario and trying to make the business remain viable. So without any further references to anything nautical, I've done enough of them. So it's time to get along with the webinar. Now, each presentation is going to go for roughly 10 minutes, maybe a bit longer. By all means, chuck your Q&A chat into the chat box. If we've got time, we'll get the questions answered. If we don't have time, we'll move on. And those questions will be answered by email via the presenters over the next 24 hours or so. So without any further ado, I'm going to our first speaker, Andrew Knowles from Macquarie. And I'll just transfer it over to you, Andrew. And I better take you off mute.
There we go. Thank you, Shane, and good afternoon, everyone. My name is Andrew Knowles, and I'm the National Segment Head for the Insolvency Industry at Macquarie Business Bank. Now, at Macquarie Business Bank, we specialise in providing cash flow goodwill lending to SME and emerging corporates, and to support such things as working capital requirements, succession planning, and M&A activity, as well as tailored and specific transactional banking and genuine thought leadership. Now, we're not a one-size-fits-all bank, and we only bank certain industries and certain businesses within those industries. This allows us to go deeper and provide more flexible and tailored solutions. And those three streams are professional services, accountants and financial planners, legal firms, insurance brokers, and of course, insolvency. We have property services, which is lending to real estate agents and commercial agents, strata managers, as well as property-backed lending, such as commercial property portfolios. And our newest stream is business services, so lending to the built environment, so architects and consultant engineers, the health sector, as well as technology. Now, I'd like to welcome Martin. Martin is the face of Macquarie's economic updates, and it's such an interesting point in time, given the recent events with the budget, the US election. So we thought we'd get the experts in. So with that, I'll throw it over to Martin.
So it's my job this afternoon to take you through Macquarie's view of the world in 10 or 15 minutes. So this is going to be a very quick crash course in terms of our overall big picture view. Obviously, we need to be looking where we are today and where we're going tomorrow, but very quickly, where were we coming from? In 2019, we certainly had the world, in terms of global growth, modestly improving. This was well after a time that we had the trade war, which would partially got resolved by the phase 1 trade deal, and also that we had the US Central Bank, who had started to raise interest rates in 2018, trying to combat the risks of inflation. They basically started to reverse that policy. Of course, going forward, we had the coronavirus emerge in January and February of this year. And of course, we had a significant shutdown in the Chinese economy. Now, given where we've come from, the IMF, the International Monetary Fund, is forecasting that global growth is going to decline this year by about 5% across this whole year. But they are actually forecasting a rebound of some 5%. And the main reason for that is largely the amount of significant activity and policy response by central banks and governments around the world. Now, how much do we gauge as that policy response? Well, certainly looking back at the GFC, central bank activity in terms of cutting interest rates and adding liquidity into global banking systems and into economies is about 3 times that was put in place at the time of the GFC. Equally so, if we have a look at the amount of fiscal response from governments, and obviously we've had the most recent one through the budget on Tuesday, it looks like it's about double that we saw at the time of the GFC. So this is a breathtaking, significant amount of policy response by central banks and governments. Now, despite this response, there's obviously still risks out there. And the key risk we still continue to focus in on is obviously, unfortunately, what Victoria has experienced, which is a secondary flare-up of COVID. Now, quite clearly, we wouldn't want to see that anywhere else here in Australia, but we are seeing it once again emerge as a secondary flare-up in Europe, in the UK, France and Spain. And really it doesn't look like, to some extent, the US has yet seen the end of its first round of COVID impacts. And so how do governments respond to a secondary flare-up? Equally so, we are expecting that if economic data is worse, that'll have a negative impact on confidence. Now, we do know that the economic data is awful. Every major developed world economy around the world is in deep recession. And of course, this is the worst time to have a geopolitical conflict between the US and China, where relationships have deteriorated further. And quite clearly, Australia is experiencing the blowback on that, with China putting tariffs on barley, wine, and on meat. But the biggest risk we see in the very, very short term is the US election, only because we don't know the outcome, number one, and number two is to try and gauge whether there's significant policy difference between the Democrats and the Republicans. Certainly under normal circumstances, the Republicans are more pro-business, and we've seen that from Donald Trump's policies over the last 4 years, cutting taxes, cutting red tape, and investing in infrastructure. Now, don't get me wrong, Donald Trump is not on my personal moral radar, and I certainly personally feel that he's a flawed character. But we don't think that a Joe Biden administration will in fact significantly change the settings. In fact, the global financial markets look like they're now accepting a Biden or the potential of a Biden win, and that a Biden administration may in fact add additional stimulatory action and policy into the US economy. Now, as a result of this significant activity by central banks and governments around the world, Macquarie took the view in April, and it's still very much our view that we will see, and we are in the middle of, a V-shaped recovery. That is, we're coming off the bottom. But the question mark is, how long will it be before we can get back to the same rate and pace of growth that we had in 2019? So that duration question is absolutely key. As far as we can currently see it, we think we're at least 2 years, maybe 3 years away. And of course, if any of those key risks arise, that V-shaped recovery turns into a W-shaped recovery. That is a rebound, a secondary sell down or decline, and then a final rebound. Now, interestingly enough, Australia is actually faring better than most, relatively speaking, against the other major developed world economies and our major trading partners. And we are certainly expecting that we are going to see a rebound and certainly off the bottom in our economy going forward. Now, of course, all of this stimulatory action is basically coming from the fact that central banks have cut rates and adding liquidity into the economies, and governments are raising or using an enormous amount of debt to support economies through policy changes. Now, of course, the big question is the level of debt, which is the highest it's going to be since World War II. That's certainly the case for Australia. Is how affordable is this debt? Well, given interest rates around the world are very, very low and are likely to be very, very low for quite a number of years, we're now seeing government debt rates at the lowest they've been since 1967. That means that we think the debt serviceability is actually very acceptable. Now, quite clearly, we want to see governments acting responsibly on the fiscal side and look to reduce debt as quickly as they can. But they can certainly manage this debt for quite a number of years. In terms of Australia faring better, well, the IMF, the International Monetary Fund, put out forecasts in April, as you can see by this chart, the orange bars. And at that point in time, they were forecasting Australia to have negative growth of 6.5%. In June, they revised these outlook and in fact improved Australia's outlook, still negative, but negative 4.5%. And that compared quite favourably against a number of our trading partners and leading developed world economies, where they saw significant additional downgrades to their outlook. So once again, we seem to be in a slightly better position. Basically putting in place our view that there is a V-shaped recovery, there's a whole range of data points taking place around the world that would suggest we are well and truly off the bottom. Now, this is this chart in front of you is actually quite surprising. Mortgage applications are rising. Now, this is despite the fact that we've still got very high unemployment in the United States. But the reason we think this is taking place is the availability of credit. So we are seeing that with obviously very low interest rates, we didn't see as large a fall in property prices. In fact, in the US, property prices are actually now up. We've seen a significant pickup in activity by households in regards to mortgage applications. But this is duplicated around across a number of key segments. If we look, for example, in retail, at pharmacy and consumer staples, both here in Australia and the United States, we're almost back to where we were in terms of activity levels since in 2019. If you have a look at mobility, so transportation, this time last year, there was about 220,000 flights, including cargo flights, around the world per week. That got down to as low as 80,000 flights in the March-April period, and we're now back to about 140, 150,000 flights. So although not back where we were last year, well and truly off the bottom. Certainly other data points would suggest that car sales is suggesting that households are starting to get activity again, as are some businesses. Interestingly enough, as in this chart, you can see car sales in China are almost back to where they were in 2019. This is to some extent reflective of the fact that Chinese authorities have put in place a very significant stimulatory package and policies, and the Chinese economy is almost back to where it was pre-COVID. And that's in areas of infrastructure activity, retail sales, manufacturing, fixed asset investment. Equally so, with that big stimulatory package taking place in China, certainly in terms of the infrastructure and construction side, demand on steel is rising dramatically. And so they are increasing production in their steel mills. That's good news for the Australian iron ore producers. And so the chart on the left-hand side shows that steel mill activity in the red line. The reason why we're seeing the iron ore price go up from $85 a tonne in March and April to currently over $120 a tonne is that we are seeing supply constraints coming out of Brazil. And that's clearly good news for Australia. It's not going to last forever, but while COVID is impacting Brazil, the supply disruptions are quite significant. And there's absolutely no doubt that China is very much dependent on our iron ore side. But it's not just iron ore showing us a pickup in activity. So too is the industrial metal copper, the chart on the right-hand side, that light blue line, and the oil price. So once again, we are seeing that commodity prices are giving us some signals of a rebound in industrial production. Now, as I talked about risks in my opening remarks, quite clearly the big risk in the very short term is the US election. Now, this chart basically shows not what the polling is saying, but what the punters are saying. In other words, where is the money going in terms of betting on this election? Now, as you can see, the area that was circled back in February, March was when basically Joe Biden won the Super Tuesday results and became the Democratic nominee. Certainly the punters liked or preferred Biden in the early component of that. When we had the conventions in August, we saw Donald Trump's pick up in terms of the perceptions and the voting got, or the betting, should I say, got a little bit closer. But unfortunately for Donald Trump, the first debate clearly did not have the impact that he thought it might have done. And we've seen the money well and truly go towards Joe Biden. Once again, we can't rely on polling. And obviously, this is just one area of estimations of the winner of the outcome of the election. But if it's close and we do see a contested vote, that's going to cause all sorts of confidence issues, both in the United States and certainly right around the world. So I'm sorry, we just had that slide. Let's go to the next one. Now, I use this slide every time I present, and this is a slide of how global financial markets have been reacting to all of these risks that I've touched on, even the global growth outlook. This is a chart of the VIX index, the volatility index. The VIX is basically listed in the Chicago Board of Trade in the United States. Investors, individuals, business owners can buy the VIX as a hedge or an insurance policy against risk and volatility. As you can see on the right-hand side, the VIX basically rallied very strongly on the back of concerns of the coronavirus impact. The orange line coming up on your screen is the S&P 500. That's the top 500 companies in the US share market. And of course, we saw a 35% decline in that market at the time when coronavirus first hit. But interestingly so, we've seen a significant rebound from those lows. And that's largely driven by a couple of things. Firstly, low interest rates around the world is very positive for growth assets. So growth assets are shares and property. Defensive assets are cash and bonds. And obviously, when you've got low interest rates, cash and bonds aren't providing you with big returns. Also, the share market is a forward-looking indicator. And at this point in time, the share market is certainly forecasting that we're going to see a recovery in 2021-22 by seeing earnings start to pick up. But we are expecting to see volatility start to increase as we get closer to that US election. So something we're watching very, very closely. Just a couple of quick more slides and I'll finish up. Macquarie is not the only one looking at or forecasting a V-shaped recovery, although we're probably the most positive in terms of the rate and pace of that recovery. But there's absolutely no doubt the Reserve Bank, Australian Treasury, and even a survey of key economists around the world by Bloomberg are forecasting a rebound through 2021 and 22. And our view on interest rates is very much predicated here in Australia on really what the Reserve Bank focuses in on, which is inflation. And inflation, a big component of inflation, is driven by wages growth. So no wonder the Australian government reacted very, very quickly with JobKeeper to make sure there was enough money for households to spend, even just on consumer staples and survival. But even more so, the recent round of the budget would be certainly suggesting they were having a greater focus on creating new jobs and basically wanting to see salaries and wages start to pick up. Wages growth started to decline at the end of the mining investment boom in 2014. That's basically had inflation under the range by which the Reserve Bank wants to manage inflation. That's that 2 to 3%, that grey bar you can see on that chart. While inflation is under that bar, it's likely the Reserve Bank is going to keep rates on hold. We don't think the Reserve Bank will justify cutting rates again, but we certainly think they can add other policies, particularly around access to credit. So they're going to make sure the banking system is very robust and there's plenty of funding to the banks in regards to their ability to lend. Equally so, the correlation between household disposable income and property prices is very, very clear. What we are seeing, quite interestingly enough, is as a result of the policies that have taken place, sentiment is turning on property, particularly around an increase in the number of sales and listings. But I think the most important thing is surveys showing that those who surveyed do think it's a right time to buy property in the Australian property market. This is also reinforced by the REA.com index on buyer demand, and this shows the online interactions. Now, obviously, quite a bit of the early stage of these online interactions were people who were stuck at home searching the property markets and not necessarily genuine buyers. But it has started to stabilise, except for Victoria, for obvious reasons, and that would certainly suggest that there is some buyer interest into the Australian property market, and for good reason. to some extent when we see servicing costs are very, very low. The lowest they've been for a number of decades. The actual mortgage rate is the lowest for several decades. And certainly we are seeing the housing affordability improve, particularly in those mining states. Perth, Adelaide, Brisbane to a lesser extent are now far more affordable. And in fact, vacancy rates, particularly in the high density sector, has in fact started to go down. So we are seeing a shift of money towards those areas. This is my last slide. I'll quickly finish up on this. And this is a very quick summary, obviously, of the budget that we saw. Quite clearly, the government is basically shifting or substituting JobKeeper into the market, trying to create jobs by cutting personal income tax for those who have got work, providing tax incentives for businesses to invest and to train. Obviously, access to easier credit, not only through what the Reserve Bank is doing, but basically changing to some extent the regulations around lending for the banks. Obviously, more bigger picture in terms of structural reform, looking at clean energy policy and a shift to gas, spending some money, but probably not enough, on upgrading NBN, given the huge amount of increase in volume and traffic online. But good news, they're spending $4.5 billion on an NBN upgrade. And more importantly for businesses, quite clearly a focus on regulation and deregulation, so cutting red tape. And hopefully some changes maybe in IR, where we do see some improvement in the wages side, but along with that, the necessity to keep productivity going. And lastly, although we are seeing some good allocations of funding to the manufacturing sector, giving it such a large sector to our economy, they probably need to refocus on that a lot more. But again, why shouldn't we be developing more resources towards technology, add more value to our food exports, certainly becoming less dependent on China in regards to our medical products. We've clearly got some skill sets there, and also a focus on the defence industry. So clearly there are areas that are very, very important. This slide is for all the lawyers out there. It reminds me to say to you, please take all the information I've provided you this afternoon as general advice. It's not specific to your own goals, needs and objectives in regards to either your wealth or business activities. Quite clearly, Andrew has touched on what Macquarie Bank is doing from a business banking perspective in the insolvency space and other segments. We've spent several $100 million on our digital banking platform. If you're not a customer of Macquarie and you'd like to consider to be so, please go online, have a look at that platform. I think you'll be impressed. And I know I'm going to hand back over to Daniel on this. Let me see if I can do this correctly, Daniel. Shane, my apologies.
That's all right.
Here we go. So I'll stop sharing my screen. And how do I hand back over to you?
If you just go into if you
participants,
click on the participants and then just click on the more, and perhaps hand the host back to Andrew just so he can finish off his stuff. Or actually hand it to me, because I think, Andrew, do you have any slides to?
Yeah, look, I'll just, while you're switching over to the host, I'll just share from a banking perspective what you and your clients should be considering for the next sort of 6 to 12 months in, I guess, dealing with your bank. So the key considerations from our point of view is don't avoid your banker, be really proactive and have early engagement, even if there is, I guess, signs of stress. Banks are far more willing to cooperate when there's proactive engagement. Understand your covenants, so really own that relationship and understand how you're tracking against those covenants. Don't just rely on the bank, because by the time the bank's reaching out to you about those covenants, it's a little bit too late. So that way you can, I guess, proactively reach out to your banker to have covenants either reassessed more favourably or have them waived. Have a really tight understanding of your cash flow. So banks will want to see a really concrete cash flow forecast and not just rely on the P&L and balance sheet anymore. A key tip really is to look out for when facilities are expiring. So if they're coming up in the next 12 months, credit's going to be increasingly harder to obtain. So you don't want to be caught out. So again, early engagement around extending some of those facilities. And lastly, banks really have a heightened sense of anxiety around fraud, particularly businesses that are managing trust accounts. And you as business owners and directors should also have that same, I guess, sense of awareness just around where potential fraud might occur with people within your businesses that are dealing with a trust account. So if you think there's anything we've touched on today that we can help you or your clients, as Martin said, please feel free to reach out to one of us. Thank you, Shane.